Well, good afternoon, everybody. My name is Mark Simon. I'm a partner at Traction Advising M&A. We're a boutique M&A firm focusing exclusively on B2B SaaS organizations, and very happy to introduce Brian Henley, Managing Partner of Recurring Capital Partners, who's here today. Brian will talk a bit more about his background, but he's a serial entrepreneur and founder of multiple tech companies. So for the founders amongst you who have walked a mile in your shoes. And about 9 years ago, he set up Recurring Capital Partners to provide debt financing to recurring revenue businesses. And that's the subject of Brian's session today, which we really look forward to hearing from him in a second. Just a couple of points of order before I go on to a quick background of AOA. This meeting is being recorded. Secondly, if you are okay to mute yourself, that would be much appreciated. And then drop any questions into the chat feature as we go through. And then between Brian and I, we'll kind of make sure we try and cover as many of those as possible. So we have about an hour. So before I hand over to Brian, just a quick overview of Alliance of Angels. Three things really to take away from this. AOA is really the sort of the main angel ecosystem in the Pacific Northwest in our region. The most active angel group that we're aware of, over 140 members, investing over 20 deals a year, and that goes from $250,000 to $500,000 with an average investment. And amazingly, 40% of the companies that present at these meetings get funded. Secondly, I think an association with AOA adds a huge amount of credibility for future fundraising. Despite being angels, AOA members are highly networked to other sources of capital, which can help you progress your business. And we do have other area angel groups attend AOA meetings, so that will further expand the network when you are involved with this group. And astonishingly, nearly all companies that receive AOA funding successfully complete their round. But it's not all about the dollars and cents. It's very much about the members being able to help with more than money. It's that network, the expertise. Many of them have been founders and have walked a mile in all of your shoes, and can offer a huge amount of business advice and networks and contacts, of course. So with that being said, I'm very happy to hand over now to Brian to walk through his session. And please do engage, put lots of questions through, and we look forward to a lively session today. So Brian, I'm going to stop sharing my screen, and hopefully you'll be able to take over from here.
Okay. Well, thank you, Mark. Pleasure to be invited to talk to everyone here. I think obviously this is a angel investing group, so a lot of hard work and effort to get the hardest capital there is to get, which is the capital to get companies launched. I'm going to be talking mostly about capital options for a little bit later stage, once companies have kind of gotten past the proof of concept phase and built an established customer base, and specifically talking about debt financing options, which have grown dramatically in the last number of years. Certainly since the last time I started a company, it's very different in today's world, and especially for more traditional business to business software, recurring revenue software companies, which is, the most popular model now. I understand there might be some people here involved with different business models, but anyway, just as a precursor, that's kind of where we specialize in and know the most about. But I will say, as Mark mentioned, I've started a number of different tech companies, and I've financed them many different ways, from right out of the bat raising the big equity round to fully bootstrapped and never raising a big round of financing. So I've had successes and failures in different models. So there's a bunch of different ways to do it. But I got intrigued with the predictability of recurring revenue SaaS models 8 to 10 years ago, and got excited about expanding the capital options for these type of companies beyond just their traditional equity financing. But let me just give you a brief introduction on our firm, what we do, and then kind of talk about the markets and sources of capital. So I run Recurring Capital. We have been around for going on 9 years now. We've worked with 58 companies, done close to 150 loans with companies all over the country. Have not done anything in Seattle yet, hoping to, because it's obviously a great market, a lot of great companies. But we mostly work with companies kind of in the 5 to 10 to 15 million of ARR range. So companies have been around for a number of years, built a kind of core customer base that you can really understand how sticky the software is, and that's really what we lean into. We do as small as $1 million initial check with companies, have grown to as much as 15. But I guess part of our specialty is being a recurring source of capital as companies grow. So we like to grow with companies and do multiple financings with them as they grow. And again, usually it's as an alternative to equity financing. Sometimes it's an adjunct. If those of you that are familiar with the venture debt market, that market is very well established and has been around, and I'll talk a little bit more about that. And that's still an active market, but it's generally debt coming in alongside equity. And I think the major difference with what we call growth debt is it's usually debt that is an alternative to equity financing. So again, we usually start with companies about 5 million of recurring revenue, and once companies get to that stage, they have a lot of different options of what they can do to move forward. A lot of companies try to be self-funded and bootstrapped. That can be a decent alternative for companies that do prepaid upfront annual contracts. If you're on a good growth path, you can collect that company from the companies on the annual renewal and kind of invest in growth as you get new customers. Obviously, small equity rounds are very common, either as an inside round or a new lead bringing in a new valuation from the outside and new terms potentially. Large equity rounds are also very common. Companies that have that proven customer base and are ready to really step on the accelerator and say, hey, we want to really grow our market share and grow quickly. The equity, probably everyone here is aware, the equity financings the last 18 months have been pretty difficult to get. A lot of investors are not actively deploying a lot of capital, dealing a lot with their portfolio companies, and that has certainly brought valuations down. And so you also have a lot of companies that are looking to avoid raising equity capital in this market. So it's been a very, very busy time for our firm and firms like ours, providing debt financing for companies to continue to grow their business without setting a new valuation on the company, raising potentially dilutive equity financing. So that's, part of the market. And then, with the private equity companies, firms out there, you get into majority buyouts or recapitalizations where, and this is where most of our companies end up, that they end up becoming a tuck-in acquisition for a bigger private equity platform investment. If you've got a really big, exciting market and a great team, you can get a premium valuation of being considered one of those platform investments. But those are generally a little farther down the line once companies get to, closer to 20 million plus in revenue. They'll have that option. I think one thing that is pretty clear in my experience and experience with the companies we work with is the larger you are from a revenue base, the more alternatives that you have and the better that those alternatives are. And so a lot of times what we're doing with companies is trying to get them from, 7 million of revenue to 10 million of revenue. And then the aperture of the investment market opens up quite a bit. You get a lot more options when you get into those double-digit millions of revenue. So our capital can be a good kind of waypoint along the way to help you to get along there to that next stage. And I will point out, we're not the only firm that does this, and I'll talk about some of the other players in the market as well. So just talking about debt versus equity, it can be appropriate or not appropriate in some companies, kind of depending what you're trying to accomplish and what you're trying to accomplish right now. It's pretty common, talking about the pros of debt financing. It's less expensive than equity. You're not permanently selling a big piece of your company. You can buy yourself time to delay an equity round or to get to cash flow positive. I think debt investors are generally less, I don't want to say invasive, but less involved with the company. So, the whole diligence process and the closing and post-closing, it's a lot simpler than equity financing. I'd say, for debt investors, it's much more about what do you have today versus what are you going to do tomorrow? And what are you going to do tomorrow is a much more complex assessment that equity investors are making, where debt investors are much more about, what do you have? What is the existing customer base? What is your historical renewal rates? Those things are a lot simpler to assess than trying to predict the future. The negatives, the biggest one is, debt has a current cost to it. So you're taking money out of your bank every month to pay your interest expense. And so, there's a lot of scenarios. If a company is really trying to be a unicorn and grow 200% a year, there just might not be a fit to pay that current cash pay interest expense. It obviously reduces the runway, whereas equity, you pay off equity well down the line, not today. Covenants can be all over the map depending where you get capital from, and basically a covenant is something that lenders use to protect themselves and look for ways to assess that, hey, something's going wrong in the business or something is not going as planned. And those can be, very typical of, requiring a minimum cash balance so you can make payroll. And then for lenders like us that specialize in the SaaS market, we're very focused on, are you going to retain the customers that you have today? So there's something around renewal rates of the existing customers. And then there's lenders that will, have growth covenants, EBITDA covenants, minimum kind of runway, kind of looking at your burn, how much cash you have, how much runway do you have. And then, non-bank lenders like ourselves are usually looking for some upside for good scenarios where the company does well. So we get warrants or success fees when the company is sold, or sometimes they can be just structured as a termination fee. And big negative for the investors and the founders of the company is debt gets paid off first. So it has the most senior liquidity in the waterfall when a company is sold, and that's a big part of why it's cheaper than equity, because it's taking less risk. So there's a lot of debate over how risky that is, and so it's something that we feel like the companies are making a bet on themselves, and the entrepreneurs really believe in their company, and we're gonna all work together to make them very successful, and the company is going to sell or have an exit that's going to be worth many times the multiple of our debt in the company. So this should rarely, if ever, come into play. Let's talk about when you can expect to get some debt financing. And I break this up into kind of sponsored and non-sponsored. That's a big delineation. The venture debt world has lenders, and I started my first company in 1994. I raised $10 million of equity financing, and I got a $5 million venture debt loan from Silicon Valley Bank. That is a very traditional venture debt funding with a sponsored set of equity investors. So name brand VC or growth equity or private equity funds, and a distinction of usually putting new capital into the company is when you can get traditional venture debt financing, either from one of the tech banks or the numerous venture debt funds out there. And then as the companies get bigger, the number of lenders options grows as well. In the non-sponsored world, this is more bootstrap companies, friends and family office investors, not the name brand funds with a good feeling that they're going to have capital to come help the company if things don't go perfectly. The options there in the non-sponsored world tend to be depending on the size. Under 5 million, there are an emerging set of revenue-based lenders or royalty-based lenders. One of the largest, they're based in Seattle, Lighter Capital. But they have a structure that takes a piece of your revenue each month as a payment toward the debt. And if your revenue fluctuates, your payments fluctuate. It's a pretty interesting model for earlier stage companies to scratch the same itch that we we do, which is trying to avoid raising equity capital. I see there's a question about pre-seed startups or pre-revenue. There is very few options for debt pre-revenue, unless again you have, if you raise a big venture capital round with a name brand firm, there will be venture debt lenders that will go out there. I would also say, it's just not appropriate to put an over a burden of current pay debt. Now there's convertible debt, there's safe notes, there's a lot of things that are more like equity, but they're structured as debt that you will see in the seed stage. But really kind of $1 million plus in annual recurring revenue is when you start to get more of the royalty and revenue based lenders. And then, 5 million and up, my experience is you can still there's still some tech banks that will do things in the non-sponsored space. The banks had a rough 12 months after Silicon Valley Bank and Signature going down. So it's been hard to really pin down banks on what they will and won't do, and that's been changing very rapidly. But there's a chance that they do a lot of AR lines that are basically short-term financing against receivables, things like that. And then growth debt lenders, and I'll talk more about the other lenders, but like the rest of the world, once you get to 10 million of recurring revenue, there's a lot more options available as well. This is a chart that I borrowed from our friends at Spenta Capital. Spenta is an investment banking firm that works exclusively on raising debt financing for software companies. But the big point here is in the past 15 years, the debt market has expanded dramatically. Part of that's regulatory driven, which has put more constraint on banks. Obviously, there's more capital going into companies pre-IPO because the IPOs are happening much later. So there's a lot more venture debt. But the biggest, I would say, the biggest change in the market in the last 15 years is the emergence of the SaaS model. So for those of you that have been around, the old software model, the license maintenance model, was very unpredictable, and it made the cash flow of these companies very unpredictable. And unpredictable cash flow and revenue is very difficult to use debt. So as the world 15 years ago started this path toward subscription recurring revenue models, the alternatives on the debt side have grown. And I think myself and other people in our space, we see the stability of sticky software to being very similar to an office building or a apartment building, where in the real estate world, there's, if you look at the capital structure of real estate projects, it's much more heavily debt financed versus equity financed. And I think sticky B2B software is much more like a real estate investment than it is the old license maintenance model from software. And so that has really expanded this market. The number of lenders has grown dramatically, and the banks have really pulled back in what they can do. So I made an attempt at just throwing a few logos up here just to put it some names out there of who lenders are that play in this world. So there's still an active set of banks out there. Silicon Valley Bank is still in business, and putting capital out. The terms and the capacity with all these banks has changed quite a bit. But there's an active set of banks out there that really understand and uh, work with tech companies and the whole tech ecosystem. The revenue royalty-based lenders, there's a bunch of those out there, Cypress and FounderPath and Lighter Capital and probably a whole bunch that I don't even not name brand familiar with me, but they do smaller loans anywhere from $100,000, up to $1 million or $2 million. And then, there's the traditional venture debt players that go the full scale from early stage to the very, very late stage. And there's a long set of successful firms out there that have been doing that very well, and they work very closely with the equity investors, and oftentimes the equity investors have a short list of venture debt firms that they like to work with. And then this kind of new emerging space that we're in, call it growth debt. There's players like Espresso and Multiplier and SaaS Capital and Recurring Capital that are less focused on the equity investor side, more focused on the core metrics of the company, and have found a way to get comfortable providing growth capital in the form of debt financing. And then as the companies get bigger and bigger, there's a whole lot of bigger firms out there that all the way up to the major money center banks like JP Morgan Chase and Wells Fargo and Bank of America all start lending to companies as they get into the tens of millions of dollars of revenue. So there's a different set of investors that on the debt side that you could look at different stages of your growth. Just to tell you a little bit about our structure, and we're definitely not the only game in town, as I said, but we do 1 to 15 million. We're typically doing about 50% of ARR or 6 times MRR, if that's the way you look at your recurring revenue. And that capacity grows as the company gets, 10 million or above. We do a lot of delayed draw credit facilities, so that companies can take the capital as they need it over time. So if you were call it a $6 million ARR company, and we said, hey, we can give you $3 million, you might start with 1 or 2, go make those investments, and then come back in 6, 9 months or a year and draw another $1 million. And then as you get to 8 and 10 million of recurring revenue, we can expand the capacity of that facility. Our structure is pretty simple. It's very venture debt structure type of 4-year term loans with a 18 to 24-month interest only period. And then there's a amortization of the loan that starts at that point. We may be a little bit unique in that we pretty aggressively kick out the amortization payments. We actually don't like to get amortization payments unless the company is underperforming. So it serves a little bit like a covenant for us. We kind of reassess 18 to 24 months down the line. Are things going okay? If so, we'll keep it an interest-only loan, and eventually could just be a bullet loan. We're in the 12 to 14% coupon rate in this market, And then, as I said, something on the back end that we can get to participate in the upside of the company. And then we also do write small equity checks as well. Usually there's a small, inside equity round going on at the same time our debt is coming in. And then just point out, we will subordinate to a bank. If you get an AR line of credit, we can actually sit below the bank, and we work closely with all of the banks out there that provide oftentimes a line of credit. So if there's a seasonality to revenue or cash flow in a business, it's often good to have a kind of a line of credit that can go up and down, whereas our term loan, once you borrow it, it's kind of permanently in place. So that's kind of the high level background on the market from where we see it. I don't know if people on this call are working with companies at this kind of stage or thinking about it. Part of what we do is like to talk to companies earlier in their existence so they can think about the future financings for their company, so that it's not just all going from one equity financing to another. I think everybody should know that kind of once you get a little bit larger, there are some debt options out there. So that's what I was hoping to cover today. And I see we have a couple of other questions. I don't know, Mark, do you want to read those out, or?
Yeah, I can certainly can. So we have a question from Bharat asking, do you only do SaaS? Any thoughts about a company that is selling devices and has a healthy backlog of orders and needs working capital to build those devices? They will introduce a SaaS, but not right now. Revenues are 8 million plus and growing fast.
We have spent time with companies that have a hardware component to their business. Many of them, I think of it as kind of a Internet of Things kind of market, where there's a device going to kind of establish a future recurring revenue stream. It's the answer is it depends. We certainly can underwrite to the subscription side of that business. The cash flow for building hardware inventory, for example, that's generally more appropriate for a line of credit or equity financing, not kind of borrowing to go place an order. And it somewhat depends on the cycle of the hardware working capital need. But I guess the short answer is we can look at it. We have an open mind of, there's a lot of different ways to get predictable recurring revenue. There's a lot of reoccurring revenue out there that's not contractually recurring. We've worked with a company in the payment space that was all transactional revenue. And so it was not contractual, so to speak, but there was a long history with their customers on the large number of transactions that they processed every month, and it had a good predictability to it. So we kind of started smaller there and grew with them as we got more comfortable with it. But so the answer is there's potential for getting this type of financing as well, if you have that hardware model as well.
Right, thanks. And Bharat, if there's any further clarification, please do raise your hand or drop a note in the chat. I have a separate question that's come to me from Margaret Wong. Are there any good tax strategies or benefits for debt financing?
Well, I'd say most of the companies we deal with are not paying taxes. Um, there's, uh, you know, most of the companies are really either running at break even or losing capital, losing money, and they have built up some operating loss history with from a tax perspective. So it's not something that I think would be a driver to really think about as far as some tax benefit. I mean, there's deductibility of the interest expense, but not a major tax play, I would say.
Right. Okay, we have Vikash asks, what kinds of covenants or terms can be negotiated in venture debt agreements to protect startups' pre-money valuation?
Um, Protect the pre-money valuation. I'm not sure I totally understand. I mean, the uh, the debt structure is usually negotiated outside of the valuation of the equity conversation. It can obviously be a factor for investors of providing additional runway for the company. They can view it as another source of capital coming in, but it's usually not. The covenants and the terms are not directly related to the negotiation of the pre-money valuation, is what I'd say.
Yeah, Vikash, let us know if that answers your question. Otherwise, I'm sure that Brian would be happy to continue that conversation directly. A couple more questions coming in, which is great. Peter asks, can you provide further details about the early meeting you mentioned with founders to help them understand their debt financing options going forward? Are these charged consulting meetings or are there other later engagement expectations?
Yeah, no, we all of our investments come referred to us through just a network of advisors, um, and banks and other lenders and investment banking firms and outsourced CFOs. And so there's just a whole bunch of people we network with that, for example, this call, it's to hopefully plant a couple of seeds and down the line or perhaps even now provide an opportunity for us to find some interesting companies to work with. But when we talk to smaller companies, entrepreneurs, I mean, I'm an entrepreneur at heart, and I always try to be helpful to people. If it's not a fit for us, um, offer some ideas on some other lenders that it might be a fit, or if it's too early, can talk about when it would be appropriate. We've even gone as so far as to you know there's a $3 million ARR company that is intrigued with this, and we can kind of look at their plan and say, yeah, if you hit your plan, it's second quarter of next year, we should be able to give you $1 million or two, kind of, if things continue as you expect them to. And so you work that into your thinking of, okay, if I can just get from here to there, I'll have this other source of capital available. But no, we don't charge for that. We just see it as kind of establishing a relationship that will potentially come to be an investment for us in the future. We've had several cases where we have done that, where we've had an early conversation, kind of said, it's too early right now, but you hit your plan, and then they come back and say, hey, we've hit that level you talked about, and then we've been able to do something at that point.
Yeah, and you help them on the way up, right? It's feels good to be helpful, right? That's certainly the approach that we take as well. Another couple of questions here. So actually another one from Margaret. She asks, do you feel the strain that debt financing puts on a startup's cash flow can cause difficulties in future equity financing?
Yeah, obviously, if you don't build enough time to 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 put together a future equity financing, those debt payments could start to be a strain. I mean, it's another it's I kind of think of it like, it's a personnel expense. It's something that you have to pay, and you have to include that in your cash flow forecasting. I think as far as leaving what an equity investor would think about of, hey, some of my cash is going to go to pay a lender after we close our equity financing. That is certainly something that they will look at closely. And oftentimes our loans get paid off when a company raises a larger equity round, and part of the capital from that equity financing is used to pay us off, or they kind of jump into that sponsored bucket and can get different options on the debt side. So that sometimes there's a equity round and a venture debt slug that comes in. The venture debt pays off our debt, and then the equity funds the burn of the company going forward as new investments are made.
Got it. Okay, so just running down the questions here. Oh, we have another one here from Mark Taylor. How long does it typically take from initial contact to funding?
Yeah, the typical cadence is we'll get introduced to a company. We'll have a kind of 45-minute introductory call. We'll introduce ourselves, similar to what I've done here, and then the company will introduce us to the company of, hey, here's where we are, here's what we're looking for, and we'll talk about things about, what's your renewal rate, what's your burn, what's the capital structure like today, who owns the company today, and cover all that in about 45 minutes. And then and we'll talk about, kind of some high level, hey, you're 8 million of recurring revenue. We could probably do something in the $4 to $5 million range. And here's roughly what it would cost. And if all that sounds interesting, then we'll start a due diligence process. That is, we send a diligence request list that's got a bunch of things on it. We tend to try to work with companies of, well, at least to start with, send us what you have. Send us your historical financials, send us information on your customer base and the retention numbers that you have. And we try to, within a couple week to 2 weeks, process that information, get back to a company with some high level thoughts. We may have a call in the interim to get some understanding of nomenclature and breakdown of the customer. Sometimes, many companies have several different products that have different kind of revenue profiles. We'll get an understanding of that. But usually from there, you get to a term sheet where all of the terms are laid out. And once a term sheet is signed and agreed to, then there is a 2 to 4 week legal process to get the loan closed. And so, all in, it's probably 6 weeks to 2 months from initial call to closing, money wired, if that's helpful.
Yeah, it's very, very helpful, Brian. Thank you. I'm just looking to see now. I think that might be. Oh, hang on. No, we do have another question from Taylor that's just dropped into the chat. Approximately what type of default rate do you expect on these loans? What sorts of activities do you pursue to avoid that outcome when a company is trending toward default?
Yeah, that's a great question. Obviously, when we're doing a loan, we are not expecting there to be a default, and um, we have had in 58 companies, we've only had one company that we had to really go through a tough workout situation, and it's probably because of the latter part of the question of what do we do to try to avoid that. So once a loan is closed, we and other lenders will typically get monthly reports, financial reports, and KPIs. And we have a team here that is reviewing those. And obviously, we're looking at cash balances and burn rate and kind of retention history and performance of the company. We can see if things are going the wrong way, or many companies, they spend the cash with the expectation that, hey, we're going to get to cash flow break even, or we're going to get to another financing round. And sometimes with us, if things are going well, it's like, hey, we're going to get more capacity from recurring capital to keep investing. I mean, we've had a couple of companies do 8 different loans with us as they grow. But we have to, try to, and we generally have quarterly calls with the companies of, kind of reviewing things of, hey, look, here's what's changed versus what we were expecting. Here's kind of what the new runway looks like, and kind of have these conversations of, okay, what's the prospect for new revenue coming in? If you don't see good prospects there, what are your options for cutting costs or raising money? But having a conversation that tries to, make the company aware that we see that the time frame is shrinking and something needs to be done to avoid a default. But we try to get, I think part of the reason we've been so successful is we do have an open dialogue with companies and talk to them sooner rather than later.
Interesting. So moving on from the default question, Bharat, who asked, actually was the first question as well, came from Bharat. He asks, what's your source of capital and what are the interest rates you're charging now? I think you touched upon that a little bit, but it'd be good to expand. These are floating rates, I suppose. Any payment penalty for repayment in a hurry?
Yes, great questions. Yeah. So we raise funds from high net worth investors, family offices, some small institutions, very similar to what a private equity firm or a venture capital firm. We're on our 4th fund that we just started our 4th fund in last fall, and yes, our interest rates, which are kind of in the 13%, is a good kind of anchor in today's market. They are floating rate. It's one of the commitments and one of the ways we get capital is we commit to our investors of, hey, if interest rates go up, we're gonna give you a higher return. So they see it as a good investment. We do have prepayment penalties that if the loan is, and those penalties kind of go down over time. I think you'll find most lenders underwrite a loan that, hey, this loan is going to be out for a number of years, but if you pay it off early, we've done all this work, we get compensated for something that gets paid off quickly. I would say what's been 100% true in our world is when we have been paid off early, the companies have actually been very happy to pay those prepayment penalties because something good has happened. Usually, they're selling the company. They're moving on. We had one loan that was out for 3 weeks because the company had a deal to get acquired, and they were getting to the very end, and the buyer was getting kind of squirrely and trying to renegotiate the terms. We put our debt financing in. The entrepreneur was able to go back to the buyer and say, look, we have a clear path to move forward without you. So either we close this deal on the terms we originally agreed to, or we're going to move on. They ended up closing that deal on the original terms, and that was one of the happiest investors we had. I mean, it was a I would say on the more costly end if you just looked at it on its own, but given the amount of money that we kind of saved them from having to renegotiate the price, it was peanuts compared to what they were able to do in that. So yeah, there's prepayment penalties, but they go down over time. We're just trying to protect ourselves from doing a lot of work that turns around and spins out of our through a prepayment real quickly.
Well, I think that's the end of the questions. It certainly feels good to end on a great story like that as well. So I don't think there's any more questions. If that's the case, maybe we'll wrap that up now. Brian, thank you so much for really illuminating and fascinating topic. We've had lots of questions, lots of engagement from the group today, 30 or 40 people, which has been great. So for everyone who's still on the call, I believe we will be sharing the slides and the content afterwards. So, and if you need to reach Brian, his contact details are on the screen right now. I'm sure he'd be happy to follow up with you directly as well. Just remains for me to say thanks for joining, and stay tuned for more great AI content.
Thanks, everyone. Appreciate it.